Uh, He calls your puts. God, I love that. Wonder how many times a day I get asked that. Welcome everyone. How we doing? Hope everybody had a good trading day today. Mine was boring. I'm not having the best week I've ever had. I was able to catch most of this though at the end of the day, so that sweetened the day up a little bit for sure. Nice little pop there. You got some news going on or what? Wow. Bureau of Labor Statistics calling their staff back to make a CPI report by end of month. That's shocking. No, that was yesterday. I wanted the gap out, and we got the gap out. Unfortunately, didn't short it. I wish I would have followed the plan though. Plan worked. Nah, this market's buy the dip. They close you red, just buy it, you know. Everybody else does. Welcome everybody. We'll give it a few more minutes here. Hope y'all had a good day. Oh yeah, I think it's all on my tab. Two questions about it. Yeah, we can talk about that in the beginning. Give me 1 second. Typing up another post. Get it posted. So I keep it super simple. If yeah, I all of this is posted in my tab, I believe. So I use a buy and a sell volume. I like them up here to just be able to glance at the numbers. I'm not overly concerned with the numbers, what the actual number is. I'm more concerned with, the number going up in the direction of the way that I'm trading. Then I'll of course take note of, buy and sell switches on the day. If you end up with more buyer volume, more seller volume, and they swap, I'll always take note of that because it'll often be an area on the place that will be pretty, or an area on the charts that'll be pretty defended. So just two same study run two times, two different time frames, 5-minute candles, daily candles, or so overall volume. Down here, 50 EMA, that's going to be standard on every broker you got. 20 EMA, that's going to be standard on every broker you got. Then this one is, it's not anything fancy. It's VWAP, and then it's the hourly 20. Most of you know I love to make use of the hourly 20. It's a really, really powerful level, generally speaking. So this is the hourly 20, but shown on a 5-minute chart. That's why it looks stair-steppy. And then the bottom side of this is actually VWAP. So when VWAP is above the hourly 20, we're shaded green. When it's below the hourly 20, we're shaded red. And then if the candles, if the candles are below VWAP, then VWAP is going to show up as red on there. And if the candles are above VWAP, VWAP is going to show up as green. And then down here, this is just a fancy study, volume study. Tells you, the selling of the current candles you're in, the average over the last 9 candles, 60 candles. You can change it for time frames, but it's all pinned to my tab. I think if you have any questions, just feel free to ask. But you don't need the ribbon. And I will say basically everything on here, it should just be pretty standard on most brokerages, I think. Except the hourly 20. That's going to be a unique one. So obviously I have it on Thinkorswim, but I'm sure you could find out how to do it on some other brokerages as well. Yeah, TradingView. I'm sure a lot of them have it. And there's even, if you want, you can Google on the internet, what is the hourly 20 on a 5-minute chart? And it'll tell you, like, I don't remember, the 250 EMA, something like that. I mean, don't use the 250 EMA, but something like that. It's like someone vandalized it. Nice. Love it. Good for them. Al Brooks. Al Brooks is the reason I look at the hourly 20. That's a thing that he does. He doesn't mention it a lot, but it's a lot of the time when you'll hear him mention, those 20 EMAs, he's discussing the hourly 20 EMA. Okay, so welcome everybody. Oh yeah, yes, you approve. Thinkorswim, I will say it is a memory gobbler on the all computer, that's for sure. I know some people have a little bit of trouble running it. But generally, unless you got a bunch of screens and stuff, you should be all right. Every once in a while you'll get a little bit of a slowdown, but it definitely gobbles some memory without a doubt. Okay, so welcome everybody. Happy to have you here. I hope everybody had a great day today. Dirty River, we are going to be talking tonight a little bit about contract selection, a little bit about options Greeks. This isn't a deep dive Greek lecture. In fact, when we start talking Greeks, I've really simplified it to the ones that are really going to matter for you. We'll of course kind of mention some of the other Greeks and how they can help us or hurt us. But we're going to be talking about contract selection, and then how to use the Greeks in our favor, and what are some trades we can look for, and what should we really be looking for. So we're going to cover the 3 main types of trading that people are going to do. Your scalping, your day trading, and your swing trading, and how I like to choose contracts for that, and why I might choose the contracts that I do. Whether right or wrong in the end, I can at least give you guys the reason of why I choose them. And so you guys know with me, I'm always going to take things back to the charts. To me, that's kind of the most important part. We need to be able to apply this to charts. And so I'm also going to use myself as an example. I know a lot of you probably trade with me in voice chat. So like I said, Dirty River, happy to have you here talking Greeks, talking contract selection. And I'm going to start with scalping contract selection. And specifically, for me, welcome everybody, welcome. For me, if I'm scalping SPY or QQQ. oftentimes with, your big names that everybody likes to trade, your Nvidias, Googles, whatever they are, scalping is just not really the answer. The contracts are a little bit more expensive. You can get same day spies for scalping for very cheap. But the individual names, I just don't like to scalp them as much. Contracts are too expensive. If I'm going to be buying, 180 or $200 contracts, I definitely want to be able to get a little bit more than just, a small move out of them. So if I'm scalping, I'm always going to be looking at, your spies, QQQs, IWMs, your things that typically have same days and typically provide pretty good volatility. And so that is a big part of contract selection. And when you're picking your contracts, you need to ask yourself, how quickly do I think this move is going to come? And so if you're scalping, at least how I teach people to scalp, your move needs to come quickly. Right or wrong. What I tell people is when I scalp SPY, I want to be right or wrong instantly. That's just what works the best for me. Because when you're trading a same day, you don't want to sit in them all day. Can it work really good? Can you catch a nice trend day? Yes, but on days like this, if you just held your shorts all day, I mean, sure, you were happy down here by the bottom, but there was a bunch of this day where you were super bummed and the market was really ripping against you and you were wishing you sold. So a day trade's one thing, you trade to your targets. When you're scalping, you want that movement to happen very, very quickly. And so when I'm choosing contracts, I do have an interesting thing that I will do. I will, generally speaking, for about 80% of the trading day, I will oftentimes just trade right at the money. And so what do I mean by that? Well, I can't use that one. We're just going to go to a different day, random example. So, say we're trading SPY, we see the double bottom is set right here. Oh, this is actually a great example. We see the double bottom set right here. We know we have a level below us, so we felt relatively comfortable buying this. Whatever I would feel comfortable buying this. And so now we have to pick our contract and we have to ask ourselves, how big do we think this move can really be? And what is the move that we are looking for and how quickly do we expect it to come? So we're expecting this move to come quick. It's a double bottom. Our level is right below us, so we know our stop's very tight. Well, how much movement are we looking for to the upside? And when we're scalping, our first target is going to be this 668, 70 number, doesn't matter right now, but basically a buck move to the upside. That's going to be our first major target right there. Not to say we won't trim a couple, but now we go pick our contract. And how can we pick our contracts and how can we use these things to help us? So this might be a little confusing just because we're going to use tomorrow contracts, but this right here, actually, can you guys see that? I hope you can see that. Yep. Let me make sure. Okay, yep, but I'm on the right account. I always have a funny way of sharing my account by accident when I do this. So I should do it on the small port. So here's our contracts. Here's our delta. This is what we care about when we are scalping. No questions asked. This to us is going to be kind of that most crucial number that we care about. So we're looking for a dollar move. And we see that these contracts are going to give us, and again, we're just using a random one, $36 of delta. That's good delta. We know that our 60-buck contract, if we get a buck move up, it's going to pay us $36. That's a 50% return on this bounce to this high. We also know on this stop down here below us, that's going to be about, I don't know, 30 cents, we'll call it. We know with that stop right there, we're only going to lose 1/3 of this. So we're risking about 12 bucks to make 36 bucks. One risk the reward trade, really good trade. I'll take it every single time if it lines up on the chart like this. But we want to be right at the money because on something like this, yes, the contract is half the price. However, the delta is so much lower. What if we want to trim these contracts, but we're only up $1 to $2, $3 on this nice little pop, whereas the in the money contract has paid us $10. We want that higher delta to increase the money we make on a smaller move. So when I started all of this, I said about 80% of the time I am going to trade right at the money. Well, that kind of needs a little bit of explanation. So when I say I'm going to trade right at the money, if we're trading 660, 660, something like this, I'm trading those 68s, no questions asked. For me, it's, I'm going to trade those 668s. Again, this isn't a Greeks lecture, but the amount of additional benefit you end up going in the money, it like from out of the money to in the money quickly, is where a very large return can come percentage wise. Because again, we aren't going to get too deep on this. You can see these contracts that we are buying here, 36 bucks. Well, if we move $1, we know that now we're making $52 for the same size of move. So we're getting an almost 50% increase on our delta here. So, I mean, that's quick math in my head, but we're getting a 50-ish% increase on our delta here. So it's a very, very large increase by doing that. That's why we want that. We want smaller money to build up the value quicker. And so again, to circle back to this, if we're at, this 667.50, 667.60, I'm probably going to go those, I mean, 99% of the time, I'm going to go those 668s. If we're trading 668, I'm likely going to go for the 669s. I don't necessarily want to buy it in the money. If this move, if we were buying right at 668, our target would be 669. My kind of rule of thumb is that I want to be in a strike that is within my actual target. I don't want to be in 668s trading 671s if I don't think it's going to get there. Because as I said, the real benefit in options is when you can get your contracts to go from slightly out of the money to in the money. Massive benefit there. And so that's why I'm always going to trade at the money. Well, now we're going to back up a little bit. So early in the days when and of course I in no way recommend this. I don't think anybody should really ever be diving in on first candles of the day or anything like that. But when we're trading earlier in the day, I will oftentimes trade a little bit more out of the money. And why would I want to trade a little bit more out of the money? Because, and this is a little bit more advanced, the contract is going to be a little bit cheaper with a very high delta, and it's still going to hold that volatility early or that IV value, a little bit of leftover time value. All of that is still going to be in there. So when we're trading early in the day, and all you guys trading VC with me, say we're going to buy this and we're going to use this, we're going to use me as the explanation today. So say we're going to buy this support right here. Why are we going to buy this support? And this is a funny one to be talking about. Why are we going to buy this support? Because we know when we will look left yesterday, this zone was a launch pad. And so when we are looking at today, we have to be looking for the bounce right here. So it's early in the day, and this is an alert that I gave today. I alerted some 673s. We're trading 671.50. We could have traded those 672s, but I wanted that additional comfort, or like that additional, not confirmation, but that slightly cheaper dollar value for the potentially slightly higher multiplier. We were also seeing a good bit of selling, early off the open, we crushed pretty hard. Nvidia was like the only thing staying up. So there is a little bit of risk to be trying to catch this early dip. So we reduce our dollar risk per contract on that. And when we reduce our dollar risk per contract on that, we're able to be a little bit more lenient with our stops. So ultimately today, as you can imagine, I let a couple of candles form. I said, okay, we're holding this support good enough. We took our entry on this dip by candle. I believe I got to sell one of them or two of them for a little bit of profit. And then two candles later, we broke what was support to us. So we take our stop out right here. Because we knew kind of below these wicks was where we wanted to end up getting out of that trade. So, there was a couple bucks to be made. We were ideally looking for this, basically a $1.50 move, $1.25 move up, and then only having about, 60 cents of risk on the downside. So one risk, two reward trade. But we went slightly out of the money for that. And then ultimately, I think I ended up taking a $6 or $8 per contract loss, maybe $10, I don't know, not very much. Whereas if we were at the money, we would have been about 20, $25. So when you're taking those riskier dip buys early in the day, you can kind of fudge the numbers a little bit, and let those slightly out of the monies give you a slightly better multiplier. I'm seeing I got some questions here. What exactly is delta? Al Brooks answered it for you. It is how much will the contract move if the stock moves $1. So I try to teach this all the time. A lot of people don't grasp it. You hear people, trade floor and voice chat, oh, they're buying options, it's going up, That's not how it works. So delta tells you exactly if, well, it tells you if the stock moves $1, if SPY goes up $1, you will make $50. If SPY goes down $1, you will lose $50. It's not exactly perfect like that. There's a little bit of extra Greek stuff that goes on in there because, as we were discussing, delta increases when it goes in your direction and decreases when it goes against you. But delta, for the most part, tells you your risk and reward before you enter the trade. So this is why you really need to know what your delta is. Otherwise, you don't know how much money you are risking or potentially making. So let's see. Yeah, delta moves all the time. So, delta is going to move. There's another Greek, gamma. We won't be getting too into it. But gamma is what tells you, kind of same idea as delta. For every $1 the stock moves, gamma tells you how much your delta will move. So gamma is to delta what delta is to stock price. So it's another one of the Greeks. You don't need to get too hung up on it. Just know that when it's really going in your direction, it really helps you. And gamma will always be the highest right around at the money. And so I guess we can just do a little bit of explanation on this. So we buy these 672 calls for $100. If the stock moves $1, we're going to make slightly over $50 because gamma is going to increase our delta as it's going up. So you can see right here on the chain, we're $1 in the money. It's worth slightly more than $50, more than this contract. You're seeing the little difference right there. However, now our delta has increased to 66. So when we go from 159, now we're going to find ourselves up here at this 230 range if we get that next move. And again, if we get another one, 80 delta here, you can see it is going to be about a delta value higher when you move in the money. Works the other way, unfortunately. So you can see $51. Well, I can't say unfortunately, we'll get to the unfortunate part, but $51, you see how this is actually only $40 less? That's because your delta is decreasing while you're losing value. Where the issue lies, and this is getting way too Greek discussion, where the issue lies is you will lose delta slightly quicker than you will make it back. So, we've all bought a contract and it gets back to the same price that we bought it at, and then it's not worth the same value. Part of that is some gamma, and a little small part of that is theta, which we're going to get more into on day trades and scalping, or day trades and swing trades, obviously. Let's see. Do I limit buy contracts? 100% of the time. I limit buy and I limit sell. I can't say 100% of the time. 99% of the time, I limit buy. And oftentimes I try to have my limit waiting. So, let me find. Okay, this is actually a limit order that I hit today. So I had, oh no, actually I forgot I had to chase it a little bit. So I had an order sitting down here, as I recall, it was for like $47 or something like that, $48. When we were trading up here. This is where I wanted to buy it. I knew that. And so as I recall, my limit didn't actually fill, but I bumped it up a couple bucks and it did fill, But yeah, I will always limit, especially on scalping. You have to think these contracts are 50, $60, $40, whatever it is. $5 is 10%. So always think in percentages and don't think in dollars, and ask yourself, do you want to chase a trade that's up 10%? But I always like to do a limit order. Plus I just know the price I want to buy at. So, I like to do a limit order. Opening range is these two dark blue lines. And so this is the highest high and the lowest low. It's technically this one for the first hour and a half of the day. That's the one that I like to use. I know people use a bunch of different ones, but these dark blue lines are my opening range. It adjusts every day. Um, Exactly. It doesn't change after 11 a.m., but it does adjust up until there. And so I'm actually happy you brought this up because people were asking about the indicators earlier. If you use this, this is going to move every time a candle closes and a new lower high has been set until, yeah, 11. Yeah, sorry, I'm on the West Coast. Yeah, until 11 a.m. Eastern time. So even though this right here it's 8 o'clock my time, but 11 o'clock Eastern time, even though this is 8 o'clock, this is the lowest low. So of that first hour and a half. So that's where it's set up. But it will adjust to there. Because we know if we stay within the opening range, then we are very likely in range trading activity. And I love to, as I was mentioning, I don't know if you're in there, but in Pro Trade Floor, I'm a big believer of entry is everything. Entry gives you the best possible entry. So I love to look for setups that have repeatable results for me. And the opening range is very, very oftentimes going to be your highs and lows of day. Breakouts of it aren't very common. I don't remember, let's see. Uh, you know, when they do come, you can oftentimes catch a trade on it. I'm trying to find one that had like a really sweet trade off of it. I mean, this was a pretty good one. Movement around it is just it works very, very well. I teach all the time that the market spends most of its life in a range. And so you want to have something that can help you potentially identify a range relatively early in the day. I know this is an hour and a half in. I have another way that I do kind of teach people to do it as well. But I'll take trades off the opening range, double tops, double bottoms on it all the time because they oftentimes will offer a very low risk, high reward trade. I mean, that's even this one. I would have stopped on any selling under here. Even absolute worst case scenario down to here, I'm risking around 50 cents to the downside, but my upside target's a buck overhead. So I know I have a one risk, two reward trade, but this is a trade where if it does start breaking, I'm likely going to take the stop out. You can even see this one. Ultimately, if you were stopping just below the opening range, your actual risk ended up being 17 cents. So it just tends to be a very strong spot on the chart. However, when you break outside of it, you now get to use more market statistics that once you have broken out, you now have a higher chance. Say this thing broke to the downside, you now stronger than it did. Let's go back to this one. I know this isn't what the lecture is about. We'll get back to everything else soon. So, and then let's see. Well, yeah, that would have been my 8 o'clock candle. So when you get strong breakdowns from it, one of my favorite things, and this is one of my main uses for it, is something called a measured move. When you have, early in the day, we moved $2.40. When you've broken out, strong breakout, maybe you even take this short, ignore the blue line. That's not it. This is for today's opening range. Now you want to start looking for somewhere around a measured move down. So this move is equal to this move. It went a little lower, ultimately set the double bottom. You can start to look for that after a measured move is set up. But it can give you a nice little target just based on that range. So when you're determining risk reward on a scalp, um, I'm a nerd for this stuff. I like looking at Greeks. I like this stuff. So I am very good at, we're just going to look at this chart right here. Like I said, 50 cents maximum risk. Say we're buying these contracts, they cost $62. I know that delta is based on a $1 move. So if the risk is 50 cents, and my head does this very quick. I understand if other people's don't. I just look at this really quick and say, okay, I got 18 bucks of risk because it's half of that number. So I can say I have 50 cents of risk. I have half of one delta. Half of one delta is 18 bucks. I'm risking $18 on this trade. I do it just quickly like that when I'm scalping. And then when I look at the upside, like I said, $1 of upside, I'm risking 18 to make 36, knowing that it will likely be slightly less than 18 and slightly more than 36. Do you get that? I will not say always, I will not say usually, but I will say the risk reward is there to attempt to look for some sort of measured move. A situation like this can set up though, because the bigger statistic in the market is 80% of breakouts and breakdowns fail. You're much more likely to have trending. I mean, the market does two things. It trends and it ranges. So all trends will always turn to ranges and all ranges will always turn to trends. Doesn't mean up or down trends. We just know once we trend, we eventually range and we eventually start trending again. So on something like this, you can just look at it and say, well, I can short this and potentially get our measured move. It would have been a big one, $3 today. But so it's simple. All you do, I draw this line. It's $4. Our range, our range right here was $4. So theoretically, the measured move down is $4. You of course need to be realistic and ask yourself, okay, SPY has already sold, whatever it is, SPY has already sold $4. Do we really think it's going to sell $8 today? Probably not. You need to be like realistic in your thinking. However, if you take this short, your belief is selling below the opening range. You need to have some intermediate targets. You don't ever just hold for a measured move. It is a potential ultimate target if you're lucky. However, if you short the breakdown, you never really get hurt. Like you can stop out on any of these closes back over it. It's what 30 cents up. So if you're trying to short the breakdown of this, it is reasonable. You're seeing some patterns, even kind of triple toppy sort of action right here that maybe you want to short it. You also have your strong level right here you should be trimming at. But if you are shorting around this opening range, the breakdown retests of it, you're never going to feel that much pain. Or on like the other one we showed in the other example, or maybe you do get the really nice move and you get the breakdown, maybe short this little push back up or whatever it might be, maybe short this little bounce up, whatever it might be. Sometimes it's going to work great. Other times it's not going to work that amazing. But it can just be a really great way to identify, we don't care where the bottom is, to kind of identify some potential places where, okay, we're up here. We've tried to break out a few times. 80% of breakouts fail. Maybe we want to try to catch this fourth trade. You guys can go actually find this one and trade for it. I took this trade. Sure, you are kind of buying at the highs. You're buying near a double top, but you're setting up a nice little pattern for a very low risk move to the upside. Could my ultimate target have been, the full $2.16 measured move? Yes, but you can see how disappointed I would have been. It never showed up. Still got a nice move, but at the measured move is where you want to start, if you get that whole move, you want to start easing off. Like you've got the statistical best move you should, so you move on. But for measuring it, all you do is measure the opening range. Maybe use the 1 hour opening range. You can use that as well. Today was probably a day where the 1 hour opening range handed it out pretty close. How long do I wait after the market opens? It changes every day. Sometimes 1 minute, sometimes 1 hour. I let the market tell me to take trades. That's for me, I let the market tell me to take trades. I don't ever try to force anything. You know, I just look for a setup that I like, and when that setup finally sets itself up, then I buy it or I short it or whatever it is. But there is no nothing to the market as far as time or anything like that. You trade when the market tells you to trade. Okay, so any more scalping questions? I know we got a little off topic there, but I love the questions. So thank you guys. Always ask questions. Any scalping questions there? You guys might have forgotten we are talking contract selection. Basically, go right at the money. You're always going to be your happiest. It's going to be the easiest math on figuring out your delta, and you're going to get the largest dollar reward on the smallest dollar move on the stock. So everybody get that? Okay, so moving on, day trading. So, exactly, Al Brooks, most range breakouts fail. This was a really good one. Uh, where was that one that I just talked about? I mentioned it. Okay, this one. So this was a good one. So you can see, and I've since deleted my trend because I also let a three push wedge to short, you know. But I've since deleted my trend. So this was one where statistically speaking, most breakouts fail. So this is a failed breakout in my mind. This is a failed breakout in my mind. This is a failed breakout in my mind. So but we're holding the support we want to hold. We know we're breaking up or we're breaking down. Market's trending up. We want to lean on the side of bullish. You know, we've even got above the pre-market trend. We're holding above the pre-market trend. Everything's kind of pointing up, you know? So this was one where we buy this dip down with tight stops and we look for the breakout, you know, third, fourth attempt, you know, this was a failure. This was another failure, failure, depending on how you, if you're looking at just individual candles. Most of them are going to fail. So the people who bought this wrecked, people who bought this wrecked, people who bought this one wrecked, and you sit and you patiently wait and let the market set up. So this might have been a time where I sat and I did nothing from 8:55 my time until 10:10. And then we buy right here and we make our money quick. That's what we when we're scalping, these are the types of setups we want to look for. So day trading, contract selection on day trading. As always with all of my trading, anytime, I think no matter what, no ifs, ands, or buts, your entry is the hands down most important thing that you can do. It turns, I was talking this in trade for earlier today. Turns a good trade, great. It turns, keeps a bad trade, not too bad. That is why I care so much about entry. And I kind of want to talk about this because in voice chat, I get asked all the time, what do you think of this trade? What do you think of that trade? And then somebody will say to me, like we had somebody who was yapping away in voice chat this morning, and he wanted to be short here. And I just told him, hey, to me, the market's at a bounce point. We've already taken a nice hard sell. To me, I'm looking at this saying, here's our yesterday zone that we exploded off of. I know that I want to be a dip buyer right here. Right or wrong, safety for me is this. Well, he was obsessed with being short, kept yelling about being short, was scared a couple of times, and I was ultimately really happy. And so I love that. I'm wrong all the time, and I'll happily admit when I'm wrong. But I just trade what the chart tells me. But people in voice chat ask me all the time about trades. What do you think of this trade? What do you think of that trade? I can only give you my opinion. And because of how I trade and because of the setups that I like to trade, I oftentimes don't see entries where other people do. Just because I don't see the entry, I'll tell you what I see. I'll tell you why I will or won't take that trade. And then I'll be right or wrong. It should not influence you if you already have the plan, because it's your plan. You might be seeing something that I don't see. You might do something, you might trade different than I trade. That is okay. I want to talk about this just because so many of you do trade and voice chat with me. If I ever tell you no, or I'm not going to do it, don't let that, beat you down or nothing like that, I'm giving you my best opinion. So always remember that, I'll be wrong all the time. I'll be right sometimes, we all try our best. So always remember that. And so day trading is, that's kind of my lead in this. Day trading is the thing that I'm asked about the most. It is what I think most people should focus on in trading, especially newer traders, because it's it's much safer than scalping. It's much safer than swing trading. And if you can build these habits of sitting and patiently waiting and letting the day trade come to you, letting that trade line up, and then taking the trade. And so when I day trade and when I do contract selection, it's going to be a similar thing. So you guys can see here, this is a trade that I'm talking about this one because I didn't take it and we were talking about it in the voice chat. And I didn't take this trade. And this is a trade that I wish I would have taken. Ultimately, it worked really good. None of that has anything to do with the conversation that we're having tonight. How good or bad a trade worked. But to me, I was watching the market this morning, Amazon selling. This is where I want to be a dip buyer. So obviously this is yesterday's low. We're just going to slap it on here. We'll even label it. Uh, and so this was yesterday's low. So to me, this is where I'm going to feel the most comfortable trying to buy this for a day trade. As I said, you can scalp the individual names, but the it's not worth the risk and the reward to try to be plucking, $10 out of a $150 contract. You can make $10 on a $40 contract pretty dang easy. So don't put that much money at risk. When you're taking these trades, it's because you want to look for a slightly larger move. Don't get me wrong. You might plan this as a day trade, and that trade might work for you instantly. Because maybe you get the explosion, maybe you get the dump that you're looking for. Just because you planned it as a day trade doesn't mean you have to hold it for the whole day. Follow your plan, follow your targets. So Amazon today, that yesterday low was obviously where I think most people should have been looking to buy. And so ultimately, we don't get quite down there. That was part of me staying out of this trade. Obviously, I ultimately regret it, but I had this wedge, everybody knows I trade these 3-push wedges. I had this wedge drawn right here. So we're going to discuss contract selection on this trade because I didn't take it. So, nobody can be sad or happy that we weren't in there. We can just discuss what we would have done and how we would have considered taking this trade. And so, I'm always going to have similar ideas, whether scalping or day trading. So Amazon, now that I think of this, maybe not the best example, actually maybe a great example because of its strikes. So Amazon, due to its value, due to a bunch of things, its strikes move in $2.50 increments. So when you look at an out of the money Amazon contract, you might notice that it actually has pretty low delta. And that's because it's so far out of the money. When we were looking at the SPY contracts, it was very easy to see those increases, do that math in your head, because there's strikes, there's 660, 661, 662, all of that. This goes 230, 230, 250. So you have $2.50 of difference. However, you can still look at this and say, okay, I know that if we move the $2.50, it's actually multiple delta. So that is why this thing over doubles. Even though it only has 29 delta and it's worth $77, it's doing well over double because this is a $2.50 difference. So when I trade these things, I do it very similar to how I choose my scalping contracts. And so just as just to stick with these, and we're going to use these prices here. We don't care where it is now. We're using these prices here. Really, if we are anywhere from 221 to 222, I am likely going to go for that closest strike, the 222.50s. I'm likely going to go for that closest strike as long as we're about halfway between the two strikes. I feel comfortable with it. However, if we're pushing up on this strike, then I am going to go to the next strike out, which is going to be the 225s. It's $2.50 more out of the money. However, there's going to be one little caveat to that. My ultimate target. If the next strike out does not let me trade, I don't think the trade is going to get there, then I'm not going to choose it. My final target needs to fall within the strike price that I'm buying. You don't want to be the person buying, 230s, 227.50s. Did they do like 1,000% off the bottom today? Probably, but it wasn't a smart trade. And why do I say that? Because we come back to this delta. you start buying these $5 out of the money contracts or sorry, $10 out of the money contracts, and you have 7 delta. And yeah, they're only 17 bucks, but options contracts have other things going on besides delta and theta. And so they're only 17 bucks for a reason, and you need a dollar move on Amazon. You need Amazon to go from here to here. Oops, wrong thing. You need Amazon to go from here to here to make $7. And so that trade's just not worth it. You need to put up the money to make that trade actually worth it. On your cheaper or on your more at the money contract, you're going to be able to make, your 30 bucks on that same move. And so it is much more helpful to do that. So when we're day trading, we just want to make sure we are within our strike price, or within our target price rather. Because when you start getting too far out, you're just being unrealistic. And if you can't afford a reasonable contract, you can't afford a reasonable trade. So this is how we're going to trade our Amazons, things like that. Again, we're trying to buy this double bottom, we're trying to buy this 3 push wedge, whatever we're trying to buy right here, we're very likely want to be in those 222.50s or 222.50s. Because this move is going to pay us nice. We're going to get to 223. We're going to be in the money. So our delta is going to be very high. And then we go, the more we move in the money, the deeper we get in the money. Again, we get to start seeing that dramatic increase on the delta, paying us more on the smaller move. While these out of the money people, they might be seeing a higher percent. They're making many less dollars on the same move as you. Buying half contracts? Yeah, I don't think you can buy half. Oh, like yeah, the 222.5s. It's just fine. That's what's for sale. They're gonna have all of those on, I mean, all the big names are gonna have those. Apples are gonna do the same thing. All of the big names are gonna have those. So that's what we were talking about, the 0.5 contracts, just fine. Everybody trades them, everybody trades them. So now the next thing that we're gonna talk about, different type of day trading. And we're going to go for something like Coca-Cola. So again, this is just going to be quick. We're going to talk about the same thing on Coca-Cola. We know buying at 66 is for the most part free money, stops under 65.80. I keep missing this thing. But we're looking at Coca-Cola. Well, Coca-Cola is a little different. We can buy this at 66, but this rip, it looks giant. It's 80 cents. So we really need to be conscious of our delta, We want to trade oftentimes in the money because we need a high delta. We're only and we wouldn't even be looking for the 80 cent move that we got here. That's a big move on something like this in, a day. So we need that high delta to make this trade worth it. If you're trying to buy these couple buck out of the money contracts, obviously it's Thursday, so they're cheaper than they would be. You're only going to be looking at 5 or 10 delta. And so on this nice big face rip, you are only going to be making a few bucks. If you go at the money and you got 69 delta on a $50 contract or whatever it is, and you get that 80 cent move up, then you're going to be doing well over 100% and making like 50 bucks on these contracts. So on these cheaper names, these slower moving names, you want to be at the money, in the money, like as close as you can be. That is extremely crucial. So any of these cheaper names, your Delta Airlines, your Bank of Americas, all of those names, you want to be trading right at the money for any day trade to make the maximum reward on the smallest move. Then let's see. I think we got some questions here. Oh, yep. Somebody asked about moving averages. They got that answered. Oh yeah, Meta. Did I regret not taking Meta on too? We talked that one about chat. No. So on something like Amazon, you want a big move. And you want to make as much money as you can on that big move. That is like quite literally the purpose of options is large moves in a short amount of time is the most profitable thing you can have. Yes, the contract costs a little bit more, but if you start thinking of things in, percentages, not dollar amounts, you can buy a whole bunch of out of the money contracts, and your delta is going to be super high. It's going to be hard to actually make it, but you can't just compare, a $10 contract to a $120 contract. Sure, you might only lose $2 on that, and you might lose 20 on the bigger one, but it's still 20%. $2 to $10 is 20%, and $2 or $20 of $100 is 20%. So it's all the same when you start thinking in position sizing more than anything else. You need to look for your, oh yeah, look, Albert's just typed, look for your opportune entry, know your risk before you enter, know your potential reward, and you have your answer real quick if you should even be buying that contract. I mean, yeah, there might be like slightly lower volume, but I don't know. I doubt it is anything super noticeable. I'll tell you what, I trade them all the time with exactly zero issues. Greeks are Greeks are Greeks. In fact, I just pulled up Amazon and highest volume of the day was a 227.50. Yes. And so yes, I wasn't really gonna get into it. Josh, you brought it up though, so why not? Uh Spreads tighten when there's higher volume and higher open interest. And there will always be higher volume and higher open interest at the money because, degens, retail traders, these are your retail traders out here buying your 247s, buying your 245s. This is big money. This is going to be professional day traders, desk traders, they're the ones putting up 56,000 volume on $100 contracts. And you can see on a nice big ripper of a day, oh, I didn't even notice. I guess the highest one is the 225, but then we got above it, 92,000 there. So people are going to focus at the money. And that's why I said earlier, if you can't afford a reasonable contract, you can't afford the trade. Okay, so now we're going to go to the completely opposite side of that for our day trade contract selection. Tesla. Thing is a beast. Thing puts in very large moves. I'm in no way, shape, or form recommending that people trade Tesla. However, it is traded a little bit differently. Funny enough, it is rare that the at the money contracts are going to be your best risk reward. Almost always trading Tesla because you don't want to be trading Tesla for a buck or a $2 bounce. You want to let big old double bottoms get set. You want to look for reversals up or down. I don't care anything, I don't care about what you're looking for, but you want real setups to set up on Tesla. Don't be the morons buying calls or puts just all day, every day on Tesla, just waiting to see what happens or whatever. Buy and then target reasonable places, sets a big double bottom, start looking for some previous highs. So on Tesla, as I said, very expensive, and not necessarily worth it to just go at the money. We know that if, and again, this is hindsight trading. I obviously didn't catch this trade, wish I did. We know that if we're buying at 426 and we're really looking for a nice reversal to the upside, we're going to be looking for a $5 or $10 move. So because of that, we can use this to our advantage. We can buy some of these further out of the money. I'm not telling you going way out of the money. You still need to be reasonable. You still likely want to be at the most a strike past your final target. So say we're buying these 426s and we're potentially looking for a move to, yesterday's highs, or at least kind of this big, breakdown point turned into a big breakout point, which I guess is ultimately where we rejected. So, about a $10 move to the upside. Then we can go to our option chain and say, okay, I'm looking for a $10 move to the upside. 440s, they're $300, 35 delta. $10 move does well, because we know our delta is increasing. So if we're at 310, we estimate our $10 move, these are going to be worth about $660. That's perfectly reasonable. Keep those strikes reasonable. Don't get me wrong, we've all seen the $50 out of the money Teslas pay like 1,000%. if you're gonna trade these big volatile names, you still need to be trading them responsibly. You still want to be, give or take within your strike value, or your price targets, you still want to stay within there. But when you have that volatility, and you're looking for those bigger moves, that's where you can find, I don't want to say safety, but you can more, you can do it without just being a degen. You're still trading within your targets, you're still doing all of that, and you aren't just buying $40 out of the money Teslas and praying. You are still, have the chance of ending up in the money, all of that, all of the same logic, but you definitely don't need to be hammering right at the money on any sort of day trades on these big volatile names, like Tesla. So everybody get that on day trades. Keep it within your strike value. Entry is everything. On those cheaper names, you very likely want to be right at, in the money, if not, cents out of the money. Your mid-range names, your Apples, your Amazons, all of those, you still want to keep it pretty reasonable. Really never going to want to be more than 1 or 2 strikes out of the money on those and still within your target price. Then you get to your big volatile names, your Microsofts, your Teslas, those types of things where, $4, $5, $10 moves are very, very easy. You can start to go a little bit more out of the money. So let's see, we got any questions here? Josh, yep, answered that one. I never use the hourly 50 versus the hourly 20 on the 5-minute chart, but I do know that um uh I do know that this, if you're using my indicator, it automatically sets it to the hourly 50. But I personally just always use the hourly 20. I like the hourly 20 because it shows me who is when we're above it, bulls have been in control. When we're below it, bears have been in control for all of today and all of yesterday's trading. That's why I like the hourly 20. Yeah, so all these light blue lines. These are all just support and resistance, all from the daily chart. I do everything off the daily chart. That's where all my levels come from. So everything comes off the daily, and then I just trade around those things, and I look for setups like this. Double bottoms, multiple legs down, where we could potentially see a reversal. Big double bottom on longer time frames. I know my stops are tight at that point. If I'm buying this, my daily level, my stop's down here. Buck, $2 below me, $1.50 below me, ultimately looking for a potential $8 to $10 move up. That's a great trade. Yeah, exactly. Okay, and so final one. We're gonna cruise through this last one. I know we only got a couple minutes left. It's gonna be swing trading. And as with everything else, entry is everything. No questions asked. Entry is everything. I don't care what your trade is. I don't, none of that matters. If you don't have a good entry, you're already setting yourself up for failure. So Apple is one. I'm slightly regretting it. A couple of my buddies were talking about it today. I'm feeling like I should have been in there. Nice support, obviously. We know exactly where we should have been looking for support. I was being greedy, wanting the 250 down here. If I'm looking for a swing trade, I love a setup. This is a fine setup. I'd love it if it was down here at 250. I'd hammer that, no questions asked. But we see we got strong support. We see we got all of this going on. We identify this on the daily time frame. Now, on the daily time frame, because we're looking for a swing trade, so we're paying more for contracts, and we are expecting a larger move to the upside, downside, whatever way we're trading. Now we ask ourselves, how long do I think this trade is going to take? So we can say we're trying to buy this bounce, and we want to see it make it back to these 257s high of range by, a week and a half, a week or so. And, don't get me wrong, there's been some big bounces. It's done it in a day plenty. But we say to ourselves, okay, I want it to happen in about a week and a half. So now we know, okay, I think it's going to happen a week and a half. I'm looking a month out. No questions. Because you don't, you might think it's going to happen in a week and a half. You might think it's going to happen in a week or whatever it is. Add a couple extra weeks every single time. Buy yourself the safety. Well, on Apple, you can see, where are our ultimate targets going to be, and how far out of the money do I think I can go, and what is my risk on this trade going to be? So when I swing trade, I always enter with a half of a position, and I almost always have a place where I plan on adding more if it shows up. So for me, I'm going to look at these contracts. Say we're trading this 253. We're just going to pretend this is the price. It wouldn't have been this much. We're 3 weeks out on these. I know my ultimate target is going to be somewhere up here, this 257.50, 260. I'm looking for the breakout. I think everybody should be looking for an all-time high test on Apple sooner than later. So 260s right here. 470, 490 bucks, a month's worth of time. I know my next ad spot is going to be down here about 451. So I'm risking $2 of downside. I am risking $80 a contract on my $400 contracts. That's a 20% loss. This is where I will add the rest of my position, 251, and I will stop out below 250.9. So I plan all of this ahead of time. I know my average down is going to, get my cost reduction down. I average down as close to my stop out as I possibly can. And why do I do that? So that I can reduce my cost basis. And then if I'm wrong, I didn't ride the full position down. Um, you know, and so you sit and you wait. That's what I hate with swing traders. People think swing trades on, there's a swing trade on Tesla every day. No, there's not. I need some confirmation to get in there and want to swing on it. And I want to build all of this plan ahead of time. So again, we get to see exactly what we're doing. We know we're buying at our 253. We know worst case scenario, we're going to be adding to these things at 400 bucks a contract, and we're just using random contracts. We're going to be adding to these things at 400 bucks a contract down here, and we're going to be keeping our stops very tight below it. Well, this is where a lot of people struggle and where Greeks become very important on swing trades. I don't care. We're buying a month at a time. When your trade plan fails, you stop out of the trade. Holding a trade to see what happens, or holding a trade because, oh, I'm down, I'm down 60%. I'm going to see what happens. It's not real trading. You can't just start, oh, whatever, it's a lotto, I don't care. You can't do that when you're swing trading. You need to have defined stops that you respect. If this thing crushes down and it closes below there tomorrow and I have a month's time, guess what I'm doing? Stopping out of the trade. That's what you do. Your plan has now failed. When we've broken below here, we start going and looking for new lows. I mean, not new lows, but like to go check out some new lows. Sure, we got the big 250 right below us. Sure, we got an EMA below us. Doesn't matter to me. This is my plan. I stop out here. No questions asked. I know that I'm going to be all told 80 bucks risk on the first couple of contracts. I'm likely going to add a couple more. Only going to have about 15 bucks risk on those. So if I add two more, then I'm risking 30 additional dollars that then I stop out on when I'm wrong. And who cares? Maybe it bounces, maybe you make money. The most important part of this is analyze those contracts for your swing trades. Let the plan play out. Let the trade come to you. And right or wrong, follow your rules. And you can see, we talk a lot about risk in trading. And yeah, these contracts are $400 for $500. That doesn't mean you should have $500 risk in that trade. Don't size for zero all the time. Sizing for zero is for 20 minutes to close on Friday. It is not on real swing trades. And really start paying attention to these Greeks when you're going to do it. It doesn't matter, cheap names, expensive names, all of it, analyze these Greeks. And then you can analyze that risk, and then you can ask yourself if that trade is worth it, and this is where you're going to get your information of, if I am down 50%, how hard is it to make my money back and get back to break even? All that info is in the Greeks. And so again, swing trading, super simple. Entry is everything. Only buy strikes that are within your target, and only keep your targets realistic. What if it dips and you execute the stop and then it bounces back up? Well, then your entry was bad, or I mean, or what I talk about all the time, what I tell people, and I build this plan and I will follow this plan. Most people won't do it. And that situation that you are talking about right there, I try to teach people all the time. Buy where you're setting your stops. There's a very good chance your entries are not good. And so, and where your stop is actually where you should be buying. And so this is actually a great example of a trade. You can take the early entry here, reasonable enough. We can even see intraday. We know where it bounced, reasonable enough early entry for a half position, because let's be real here, somewhere down into this little spot down here is a way better entry. And yeah, maybe it bounces after you stop out, but we know where we buy. We buy at 253. We buy around this, whatever this is, 250 to 250.9. That's where we're buyers on this thing. Any sign below there, the market's likely going to sell. If you are having the situation where you are always stopping out, and then the market's bouncing, that's likely because you're buying where you shouldn't be buying and you're stopping out where you shouldn't be stopping out. Like when you stop out, it has to be at a point where, if we break below, this 251 to 250 zone, we will sell. Like we will see 248. And if we get below 248, we will see 246. You have to be able to look at your chart and say that to yourself. And maybe we bounce it, I'm not going to stop out on the first wick down to 250. But if I start seeing any sort of like real selling down in this area, I'm out of the trade. Don't be the person who holds all the way down here and then it runs to 260 and act like you're the goat. If you're early, you're wrong. And not you, me too, everybody. If you're early, you're wrong. That's the unfortunate side of it. And if you're early, you're going to lose a lot more money all the time. In swings, it depends on the ticker. Obviously, KO, you better be buying 66s, 67s if you're looking for a move back up to this upper trend. 70s, like I really want to happen, feels like never going to happen. Yeah, then you want to be right at the money to take advantage of those smaller moves. But Tesla, I'm never going to be swinging at the money on Tesla. It's not worth it. The risk reward isn't there. Take advantage of the large moves that it makes and take advantage of that larger multiplier. Something like Google that slugs along all the time, you don't want to be in 255s, you probably want to have them a little tighter, your 245s, your 240s, depending where you're trading. But don't be in some way out of the money things on something that, grinds around $2-3 a day. Big volatile movers, you're safe to be a little bit further out. You definitely don't need to be at the money. Cheap names, you want to be right at the money, and then your names that everybody trades, your Apples, your Amazons, Nvidias, Googles, all of those, really just a few strikes out. It's the slightly cheaper contract with the potentially slightly higher multiplier is worth the risk, in my opinion, on swing trading. It's very beneficial. I'm not a big ATR trader. I like it. I mean, there's some free ATR stuff out there that I actually think it's really good. It's just not something I ever got into. It's a type of trading that I actually won't, say anything bad about. My buddy Lambos uses it a lot. I think he's in here. Toasty uses some of it. It's good. But I have my ranges that are based on price action. And then I use market statistics with my price action is how I prefer it. So I mean, it's relatively easy. Random Google chart right here, but we had nice consolidation right here with a breakout that set a new high. So here's our range. It's that simple. We want to look at these long-term daily charts. We got our, we had a breakout met by consolidation, big push up, now sell back down. We know where we want to buy. We had this box from back here. Once this is set, we now know our range. So when we start seeing selling down near these lows, then that's where we want to be buyers. And in a bull market, bull market is up. We want to be looking for dips to buy. Intraday, I use the opening range, your highest high and your lowest low of the first hour and a half of the day. And sometimes you're gonna have a very large range that doesn't get a lot of usage, and then other times you're gonna have a range like this that the market, well, I guess we could even go down there, that the market spends most of the day in. Sure, it's not the opening range, but we know as we start pushing up towards these highs, and you can see we stopped. If we had kept pushing up, you want to ease less and less into longs. As we start pushing down into any of these lows, you want to ease less and less into shorts and start looking for bounces. But for me, day in and day out, I use the opening range. Yeah, a measured move is a move outside of your range. It can even be inside of the range. You know, there's a lot of advanced ways to do measured moves, but it's just a potential statistical target based on your early day range. A lot of people even they'll trade the first hour opening range. So it'd be like this, you know, and all you do is you literally measure this move. That was $2.75. Best case scenario, you know, you want to find that move to 275 somewhere up here. See, sometimes it doesn't happen. Sometimes it gets close in the after hours. Sometimes it rejects straight down, but it's just for me, when I see a measured move and we've hit it, I am no longer trading in that direction. That's my opinion. You know, if we move up $4 and then we move up another $4 outside of the range, you could not pay me to buy longs then. You know, statistically speaking, it's not going to keep going. Of course, sometimes it does. You know, that's, you know, like some of these I think it was like this one, like RGTI. Some of these moves, some of these like, you know, these no name, nothing stocks have made are just insanity. But yeah, you get your $4 move, you measure it, $2 move, whatever it is. And then once you've pushed that second, you know, you've moved four, now you move another four, I'm not long. Or you've sold four and sold another four, I'm not short. No questions asked. Like, and that's about the time where everybody's getting super bearish or bullish, you know, thing that the market's going to go forever. And that's oftentimes where the clobbering comes, you know. Okay, well, that's going to do it. Like I said, swing trading, just keep the strikes reasonable. Your more expensive names, you can slightly safer go a little bit out of the money. You know, your cheaper names, you want to be right at the money, in the money. And then those middle of the range names, Apple, Amazon, that we all trade, just keep it reasonable. Halfway between target and entry is my preferred for sure. Okay, well, thank you all so much. Have a great rest of your night. We will catch you all tomorrow morning. Have a good one.